Today, let's discuss the recent depreciation of the Indian rupee against the US dollar, which touched an all time low of 85.81 in December 2024. This 3% decline of the year has raised concerns among economists and policymakers. What's behind this decline, and what role does the Reserve Bank of India play in managing it? Let's find out. Now, what causes currency depreciation? The value of a currency is determined by demand and supply in the foreign exchange market, similar to any product. When the demand for a currency falls or its supply increases, its value drops. Conversely, when the demand rises or supply tightens, its value appreciates. The central bank's monetary policy plays a key role here. A loose monetary policy increases the currency supply, leading to depreciation, and while a tighter policy can appreciate its value. Quite surprising, isn't it? Additionally, high foreign demand for a country's goods and assets strengthens its currency while low demand weakens it. Now, let's see the factors behind the rupee's fall. Exit of foreign investors. Recently, global investors have been withdrawing their funds from Indian markets due to changing central bank policies worldwide. Central banks, including the US Federal Reserve, have been adjusting monetary policies post-pandemic to control inflation. This has driven investors towards advanced markets, weakening demand for the rupee. Second reason is inflation and policy differences. Over the long term, the rupee's depreciation is linked to India's higher inflation compared to the US. Yes, the inflation is higher in India compared to US. The Reserve Bank of India is relatively loose monetary policies that have contributed to this trend. High import dependency. India's reliance on high value imports like crude oil and gold increases dollars demand, further weakening the rupee. On the flip side, India's inability to significantly boost exports limit demand for the rupee, and when there is no demand, the value of rupee depreciates. So, RBI's role in managing the rupee. To prevent the rupee from falling further, the RBI has been intervening in the forex market by selling US dollars from its reserves. This artificially increases dollar supply and stabilizes the rupee. However, this intervention comes at a cost. And what is the cost? Yes, India's foreign exchange reserves dropped to 640 billion US dollars in December 2024 from over 700 billion in September. Analysts believe that the rupee would have been depreciated much more if not for the RBI's efforts. And historically, we know that the RBI has aimed to manage the rupee depreciation gradually, avoiding sharp volatility that could disrupt the economy. In conclusion, the rupee depreciation is driven by a combination of global investor behavior, inflation differences, and India's economic structure. The RBI plays a crucial role in managing the currency's value, balancing between stability and long-term trends. Understanding these dynamics helps us grasp the broader economic picture and the challenges India faces on its financial journey. Thank you for listening.